Okay, folks, so we have three big, violent things to discuss. Number one, the latest on the market and some data that you're going to want to see if you're worried about a recession. Number two, we need to discuss Little Miss Aggregator, who is up another 18% today and just barely made a breakout past the previous high in the after hours. Will we see a massive run in the coming days? We'll break down the setup. And then lastly, number three, I want to discuss some other hot setups that you're going to need to know about heading into tomorrow and the rest of the week, including one on a particular 70-cent stock that just had an analyst report saying that it's going to go to 625. That's almost a 10x if the analyst report is right. And when have analysts ever been wrong? We'll get right into it all and I'll give you my take. Okay, Marquetta, another day of rising rates corresponding to falling stock prices in the overall indices. You have the 10-year treasuries hitting ground that we haven't seen in 3 years. The Sachs over at Goldman, who are always a peachy bunch, said that the risks of a recession are growing. Quote, with elevated inflation slowing growth from the COVID rebound and a historically tight labor market, stagflation concerns remain high among investors. And with the Fed embarking on one of the steepest hiking cycles since the 1990s, there are also growing concerns over recession risk. They did say, however, that it is too early for a recession obsession. But they mentioned what? Well, this upcoming hiking cycle being some of the most aggressive that we've seen since 1990. You go back to the federal funds rate back then, January of 1994, you started at 305 and it went up slowly, and then by 1995 you're at 605. Then it came down a bit and hung in the 4 to 550 range, and then by October of 2000 you had hit 6.51. And then after that, you had the recession period where the Fed lowered interest rates. Again, I know, shocking, the Fed lowering interest rates in a recession. You go over and you look at the S&P 500 during the beginning of that rate hiking cycle in 1994, and you trace it to the peaks in 2000 around where interest rates peaked. It ran 200%, the NASDAQ, of course, 526% up. Obviously, many hold the belief that raising rates into any sort of environment is going to be toxic and kill valuations no matter what the context. Yet, in the case of the 90s tightening cycle, you had that serving as the literal foundation for one of the most speculative bubbles of all time, which was that dot-com bubble. At no point did we have rates as low as we have now, yet you had such building on of a spec bubble. Rates, of course, in and of themselves aren't good predictors of stock market returns. They rather serve to accelerate or decelerate current trends. The reason I mention this is because you need to look at the differences of context. You look at the context of the 90s, you had strong economic growth pretty much every year after 1991, but inflation also never meaningfully picked up. The highest you had was in 1996 at 3.3%. So the markets were allowed to go up because two of the main variables were working in its favor. You had booming economic growth and inflation was kept in check. Despite the fact that that third variable, interest rates were getting higher and higher. This time around, unfortunately, you have the threat of all three moving out of favor with the market, and that's why markets are so scared right now. Right now, the market has to guess on whether economic growth and productivity of workers and wages are going to increase at a faster rate than inflation, but that tends to be a spiraling metric where one feeds into the other. And until you get that one variable, inflation, in check, it's going to be very, very difficult for markets to have a foundation to rally on like we had in the 90s during that tightening cycle. I'd argue it's difficult to be super duper optimistic about the market right now, but at the same time, I would strongly recommend avoiding getting caught up in the doom and gloom. I wouldn't rule out a very, very strong bull market when all this ends and you finally see that inflation start going down and economic expansion picking up again. It just seems like we're not near that cycle right now. But there's opportunity in every market condition, so keep your eye on the bull. Okay, before we move on to our aggregator setup, I want to thank today's sponsor, Moomoo. Moomoo is a powerful trading app that allows you to trade stocks, options, ADRs, and ETFs worldwide. What makes it powerful, Charlie? Well, thank you for asking. It's jam-packed with over 62 technical indicators and 36 drawing and charting tools to make sure you have everything you need to analyze your setups. But they also do a good job at helping you break down the fundamentals with visualized data sets. For example, I just pulled up Palantir's financials and it shows a nice visualized composition of every category that makes up their revenue. Here we see government and commercial and can even break it down regionally. You can also do the same for any ticker. Tesla, which we can see has two main revenue sources and services the US and China as the primary markets. Boeing, which has 5 revenue sources, or AMC, which has 3. Now, obviously, that's just the tip of the iceberg, and you can do a much deeper dive on stocks with their platform. But the point is, it's a resource that saves you a lot of time during your due diligence process because you can get most of your information in one place. Anyways, download the Moomoo app today and get up to 6 free stocks when you both sign up and deposit with our link down below. Thank you, Moomoo, for sponsoring this video. Now back to the content. Okay, Madam Addergator, another solid day of fighting upward, retaining value, and then having a slight breakout. She kept trying to break out during the day, but it just didn't happen, and then all of a sudden into the after hours, boom! It very rarely happens where you get such a strong momentum swing upward week after week, and then it stops and holds in a much higher region for multiple days. Usually once a huge runner dies off, it doesn't retain at the levels that it ran to. This one didn't because it retained for several days. You got the ability to get another breakout. People want to see that retaining of value so they can build on confidence. This is the third real trading day where you're not just successfully holding the fives, but you're consistently trying to hold that $6 region, and today you gotta just totally conquered it. And I was looking at this Ortex data a few hours ago, and I was asking myself, what is making this retain so well? Obviously, we've talked about this stock since very early on in the run, but its lack of real pushbacks has been astounding. The reason for the retaining power in the stock really comes down to a shift in market dynamics here. The last few months, short sellers exhausted almost everything they could to suppress buying pressure, but once you get to 40+% short interest and cost to borrow going to the moon and utilization hitting 100%, their methods of getting this down got depleted. Their ability to overwhelm the market by dumping borrowed shares dried up. Now, don't get me wrong, there's still some power and weapons left on the short seller side. They can still cycle back and forth and dump some of the shares that they borrowed but haven't dumped yet. But relative to the power they had 2-3 weeks ago, I mean, they are basically on their knees at this point. And as bears run out of weapons, the stock is more driven by buyers and even more so holders than it is by those sellers. Every buy order bids up price is huge. Why? Because there's not that many shares available. A lot of the float is locked up by people either holding this or who have already lent it out, maybe multiple times. Which means that the biggest threat to Atter's retention at these levels is arguably profit taking from holders, which would allow a new supply of shares onto the market. And I do believe that there has been at least a class of sellers somewhere in the sixes. Every time you saw this break above 6 the last 3 trading days, you got met with some sellers ready to take profits, which subdued the momentum the last 3 days. You saw that Wednesday, you saw that Thursday, and you saw that early today, but I think those $6 profit-taking sellers have become farther and farther few in between. They have come, they've sold, and they've left. And now the ones that are holding it are allowing this to run deeper into the sixes, and that's why we saw that breakout into the after hours. And I think part of the reason why all this new capital is flocking here, as well as all that old capital who's now more convicted in the stock than ever, is because they're doing the math in terms of the short squeeze setup, but also the imminent setup with the options table. You look at the options table, you now have a lot higher concentration of open interest in the 450 and the 5 strike prices as well as the 6s. As of right now, you're looking at 10,340 contracts on the 450 strike price, 12,252 on the $5 strike price, and then 8,160 on the $6 strike price. Go back to the options table that we showed yesterday. Those same contracts had 3,900, 5,600, and 3,400 open interest respectively. So in each of these cases, you have more than doubled your open interest at these pain points that we identified yesterday. Why? Well, because the probability of these expiring in the money has gone up dramatically since Atter has managed to hold the momentum this week. Means that the more Atter maintains prices where these contracts would expire in the money come Friday, the more market makers are going to have to hedge and hedge and hedge in order to stay delta neutral before Friday comes. The last few weeks, you've seen mini gamma squeezes the day before expiration as well as on expiration in preparation for these new unlikely call options expiring in the money. So anyways, at this point, I mean, I'm pretty satisfied with what Atter's doing. At this point, if Atter simply holds the $6 region, I mean, that's going to be incredibly bullish come the end of this week. But if you want to see this really rally and put pressure on the short selling side and not just the options chain, you need Atter to retain this breakout and then try to push into the 7 and 8s. I think that given 4 more trading days, there's a high likelihood that it tries. If you look at how few shares are available to be bought and how desperate short sellers have gotten, as well as how you're starting to get that concentration again at the call options that are at the end of this options chain, ones that would be in the money if this got to 7, 750, and 8, well, it's my view that if you actually broke out into that level, that would be catastrophic for the share price in terms of momentum. You would get some panicking of higher risk shorts that are already deep in the red, and you'd also get the self-fulfilling prophecy of a gamma squeeze, and you'd also get FOMO buyers. Right now, the momentum's hot. Atter continues to be one of the most watched stocks in the retail community, but you have to watch those several major pain points to see where this ends up going. $6, $7, and $8 are the 3 big battlefields. And if we do end up getting a cool down day tomorrow or the next day, look again to see where it retains value. Is it retaining at 6? Is it retaining at 550? Is it retaining at 5? All those are fine. If it starts getting down to 450 or 4, then the odds start stacking against us again. It could still recover from that, obviously, but the more it goes down, the harder it's going to be for that momentum to rebuild and that trust, as well as the less market makers are going to have to hedge. You'll probably have the opposite effect where they start de-hedging. Okay, now lastly, as you know, we do have daily morning briefings for ZipTrader U members that come out about 30 minutes prior to market open every day. And the point of these is, in addition to the rest of the program, to provide you with an actual war map to show you where the battlefields are, some crucial battle points that you need to know about that indicate a bull or a bear setup. Obviously, it's still up to you to actually fight the battle yourself, but if you take our lessons and you watch every single one of them, you should be a fierce warrior. And you'll need to be because the market is a pretty damn dirty battlefield. And of course, if you would like to join us for lifetime access in our program, we do have a coupon code expiring very soon, and we will be raising the price of ZipTrader U after that. You can learn more about that below. But the point of showing you the briefing specifically on the channel isn't to just plug ZipTrader U, but to make you aware and get you familiar with certain setups that may carry on throughout this week. And the two main stocks that I do want to remind you of right now and highlight are Nile and CEI. So Nile pumped today and then sold off, but they reported a significant asset and revenue surge. The company reported they grew revenue by 120% to 52 million bucks and ended the year of the reporting period at 490 million in assets. And as for liabilities, they are sitting at 145 million. 490 minus 145 is what? Well, 345. But the market cap of this company is only 59 million buckos. And when it comes down to why Nile is still relevant in my view as a hype trade throughout this week and into the upcoming weeks, you gotta look at the rolling catalysts and attention that Nile should have moving forward. The CEO tweeted this research piece out yesterday and said $6.25 price target on Nile. This report is by a third-party analyst and BitNile has no control over the report. And then they link to it, and I'm not saying that I agree with the report, but it's this sort of behavior that gets people excited and gets hyped into a stock. And one of the things that the report highlights is something that we actually talked about a few weeks back, which is the spin-off to unlock value. Because Nile is sort of a jack of many trades. It has investments in a lot of different sectors. It's in everything from EVs to charging stations to Bitcoin mining to real estate to lending, and it scares off some of the public capital that may just want to invest in, say, Bitcoin mining or in charging. Which means when you actually spin this off, you should be able to see an unlocking of a lot of value that has been hidden because it hasn't been able to get those buyers. Pretty much all of the major sectors that they're talking about are forecasted to grow huge this year except DP lending. So right now, the ability to invest in their growing Bitcoin mining segment or turn on green charging segment is being bogged down by people who may not also want to be invested in their DP lending segment, which is slowing down huge. Or perhaps don't want real estate exposure to their real estate segment, which is actually expected to grow pretty well. So the point is with Nile, I'm not saying that this is a long-term play or something that you should even be holding, but as a momentum play, when you do get proof of concept and runs and momentum, there's going to be a lot of catalysts as this stock continues to get attention ahead of potential spin-offs. The pre-spin-off entity should see a rise in value and speculation for the spun-off entities having massive appreciation once they actually unlock all that value that hasn't wanted to invest in it, because it's been attached to all of these other segments that investors don't want to touch. You also want to watch IMPP with the unfortunate ticker name because they are in the energy disruption sector. Indo also had a nice little breakout today as well before cooling down. Another energy disruption play. Keep these on your radar, folks. I think that you'll be surprised at the opportunities that we see in these catalyst sectors over the upcoming weeks, and we'll continue to keep you posted as much as possible. Anyways, folks, that caps off today's video. Thank you, Moo again, for sponsoring us. Get your up to 6 free stocks when you sign up and deposit with our link down below. Also, if you are looking to learn how to trade, I will put a link to ZipTrader U down below as well. Coupon code NEVERGIVEUP will get you a sizable discount before checkout, and that coupon code will be expiring at the end of the month. And after that, we will also be raising the total price of the course. So now might be a good time to check it out. Have a good one, folks, and I'll see you in the next video.